What's up, everybody?
So,
Welcome to BossBlunts Think Tank. Monday mayhem. Stocks dumped and pumped. We had a bond blowout. Commodities are chaotic. I fucking love it.
Yeah, it was a blowout, all right.
Like a diarrhea baby.
hey, boss,
What's up, brother?
can you slow down the chat?
No, I can't slow down the chat. These people don't listen to me. They do what they want.
No, you got like 500 people in there. I can't
What
even
am I
see
gonna-
anything.
What can I do about it?
Hey, don't worry. I'll buy stock in Depends just for you. And Kenny G.
Right, baby.
What's up,
Let's
everybody?
go.
Diaz, my man, thank you and appreciate you and all the mods. You guys are excellent. Thanks for taking the time out of your day. We can do a little slow mode on the future, but I like the fast and furious. We can do a speed run.
Welcome to Thunderdome, Diaz.
Whatever
Bro,
you say, Cash.
speaking of Thunderdome, we almost had a tornado come through Oklahoma today while I was at work. Thought that was going to be my last time seeing you guys.
Thankfully, it's not. You survived.
Yes.
I just figured it was because he was blowing again.
Oh, here we go.
Didn't Jesus leave his sandal somewhere in Oklahoma?
I think he did.
Okay. All right. I have no idea what the fuck you guys are talking about, so I'm just going to move along now.
Oh, fuck, I thought I was all right. Jesus.
Europe's stock market puked overnight after a flash crash in Stockholm. And reportedly, this flash crash in Stockholm occurred because some shitty math by a city index trader. Now, I've seen some mistakes in my life, but this doesn't look like a mistake. Let me share my screen for you, all you guys here in the Discord, so you can see what the fuck I'm talking about. Here we are. I'm back. I'm going to share my screen so you guys can see what the fuck I'm talking about here. Look at this OMX Stockholm.
Plus 2 equals 5 bullshit? Jesus Christ.
That was like 2 + 2 = 20.
Apparently, we're expected to believe that this was the work of some bad math by a city index trader. I highly refuse to believe that. And even if it were, this right here is market sell-off, in my opinion, due to somebody shifting positions, probably because of a margin situation, probably to maintain their margin or to reallocate their assets out of a lot of the, or to purchase new assets also, but to reallocate a lot of the things. What we saw yesterday, we discussed the video on Friday in which a new line of credit facility changes have been made. Basically, this filing creates the ability for lenders within the line of credit, of which one was just added on Friday. Friday. Actually, that was effective May 2nd, 2022, even though we did see it on Friday and covered in that video. What that does, the new filing, pretty much by the DTC, prevents the parent bank from using their assets as collateral for their sub-bank. Look at it as JP Morgan Bank and JP Morgan Holding Company. You know what? I'm going to pull it up here for you guys.
My question is that dude still alive?
Who's that?
That's a big mistake.
Oh, that? Yeah, I have no idea what happened to that guy. But that was a huge, huge mistake. And I don't believe it was a mistake. The only way for these guys to get out of something like this so quickly would be for a plunge team to jump in and save them somehow. I don't think that a fund would have the liquidity to make that move immediately upwards after making that big of a mistake. Not for the Bureau of Economic Development. I don't want to share the Bureau of Economic Analysis with you guys just yet. I'm going to hold off on that one. Let's bank derivatives and liabilities. You guys can see this from the quarterly report on bank trading and derivatives activities. You guys can see this on the Office of the Comptroller of the Currency. Under their publications, you can find quarterly reports on bank trading and derivative activities. The most recent one is for the fourth quarter of 2021. So we use the most recent available data that we've got, and it confirms for us many things. The new DTC filing that was just passed prevents lenders within this line of credit from using the parent's asset to the sub-company's holding company and vice versa as collateral. So as you can see here on my screen, let's just go to the banks themselves so you can see it towards the bottom. It'll be more clear. Here are the top 25 commercial banks. If you look at JP Morgan, for example, they've only got $3.3 trillion in assets and $49.8 trillion in total derivatives under this legal entity identifier. This is, again, banks, as you can see here. If we scroll up a little bit, we can see their holding companies. And they've got their own separate legal identifier. And they're not overseen by the SEC. They're overseen by the DTC, they're overseen by the CFTC, the Commodities Futures Trading Commission. That means that Dodd-Frank regulations from the SEC do not pertain to them. Damn, this is a lot of tables, right? I mean, because they're basically abusing lots and lots of money. Now, as you can see here, we're at top 25 holding companies up here on table 14. JP Morgan's got a different legal entity identifier, as shown here, and an additional $3.7 trillion in assets, and an additional $49.22 trillion in total derivatives, because you've got to multiply that by 1 million. And that's how you come up with 49 trillion. Therefore, JP Morgan's holding companies can no longer use this 364-day line of credit to rehypothecate their assets as collateral for the main bank, the parent bank, JP Morgan. Same for Goldman, same for Citibank, same for Bank of America and Wells Fargo. All the major ISDA players. Ken Griffin has entered the chat. Appreciate you, Reginald. So, right here, if you look at it quickly, these top 25 banks have $176 trillion in derivatives, but only $14.7 trillion in assets. And then if you go over to the part where, let's go back to table 14. This is table 14 for the holding companies. They've got an additional $234 trillion, $234 trillion in derivatives and $18.9 trillion in assets. Not all of these derivatives hold a negative value or have a a negative potential return, but the vast majority of them do. A lot of them are mortgage-backed securities and commercial mortgage-backed securities, other sorts of swaps, options, naked shorts, synthetic shares, married puts, divorce puts, a lot of things that are used to manipulate the stock market. And this creates exorbitant amounts of futures and options, OTC forwards, swaps, options, derivatives, and spot forex derivatives as well. It's all manipulation for the most part. And in certain sectors, like precious metals, it's almost 100% manipulation. Almost all of it is traded in dark pools. This is the centrally cleared derivatives. Okay? So if you look at that, centrally cleared is only 20% of all equities. So about 80% of equities to 75 or 74% of equities are traded in dark pools. 98% of Forex, foreign exchange, the fiat, is traded on dark pools. Only 2% is traded on lit exchanges, on lit markets. This is the importance of lit markets. Without them, things will be manipulated infinitely. This is precious metals. 3% in the lit markets, 2.6% in the lit markets by the various parties. Okay? So it's all these same banks, and these are their percentages. So it proves that they're manipulating the prices within the dark pools to distort price discovery. What this does, it makes it cheaper for them to buy and stock up on precious metals like silver and gold and even base metals like zinc. And look at what happened with nickel. That thing shot from 50,000 to 100,000, and LME, London Metals Exchange, had to halt trading. Cash, what's going on with LME right now, bro?
They're shutting down.
Oh, yeah. London Metals Exchange is shutting down. They're closing down all silver and gold futures trading because there's no open interest. Would you trade metals on LME if they reversed your trades? $6 billion worth of trades?
Hell no.
Fuck no! London Metals is shutting down, my fair lady. We haven't even gotten past slide number 1. Look at that. What an interesting Monday. What happened to U.S. futures at the same time as Europe futures? Europe stock indices in Stockholm collapsed, and the stocks Europe 600 collapsed, according to them, by a bad mathematician that was hired by Citi. And like Cash said, or like these guys said, I wonder if this guy still has a fucking job, if that's the case. They didn't oust anybody. They didn't tell us who it was. And we're expected to believe that this buyback here was not influenced by a plunge team of some sort. That's mighty suspect. Look at what we've got here. U.S. futures. U.S. futures also had a hiccup. And it wasn't until Europe closed that it really started to hit U.S. equities. And in the last hour, it pretty much just sparked a panic. Look at that. That's why we're up in the last hour of the stock market. It was all volume driven. It was explosive, and it crushed the volatility index. Take a look at that. The VIX on the 2-minute chart. The SPY on the 2-minute chart. Sorry, this is the ES futures. And here's the SPY. I had the wrong one pulled up. But the same shit. Futures and SPY are going to look about the same. See the gigantic aneurysm that it had, followed by a collapse and a desperation buy. And it's the same thing. Look at this aneurysm, collapse, and a desperation buyback from the 4,020 range, basically, all the way up to 4,140. Monday was absolute mayhem. And I believe a lot of it is due directly to the movement of money that's had to take place because of the short positions held by a lot of these prime brokers and banks such as Bank of America, who hold short positions on AMC and amongst many other, to the best of my knowledge, even though they're not supposed to. This still triggers volume buyback. You know, once this came down here under 40.50, we hit a big support at the 4,000 range. And the thing is, on 5/3, 2022, no one knows what's going to happen. I'm not a financial advisor, but I wouldn't be surprised to see us retest it once again. And if we test it again before the FOMC meeting on 5/3 and 5/4, when the results will come out on 5/4, which we'll know more of the date of April 4th, I would anticipate a bounce due to the positioning of the option support. SpotGamma.com is showing us some very strong option support. And what happens in this situation is a surge in implied volatility when this kind of volume and algorithmic purchasing happens. And many dealers are long on a tail end of risk. This means they're getting a Vega payout, alleviating them of some short delta obligations. In short, preventing margin calls, in short, okay? In turn, they can offer more liquidity to support the markets. Take a look at Citi's economic surprise. Went from a stock price of around 70 down to $28 a share. This here is ISM Manufacturing, by the way, and we've got last week's inflation numbers. We got CPI data coming out tomorrow for the I believe, right? We got CPI tomorrow, guys? No, not tomorrow. We've got it next week. We got it next week, so I will follow up with you guys on that next week. We won't be able to touch on that one today. Right now, what you're going to see here is that bonds are not pricing this in yet. Check this out. This is the 2-year, the 5-year, the 7-year, the 10-year, and the 30-year. And they continued the rise all day long, pretty much. All day long. They're not pricing in a recession. Treasury yields surged higher. And that's bad. That's bad, by the way. With Treasury yields, up is bad, because that's the cost. This will be the 6th straight week of losses for the Treasury if it holds through the chaos that is to come with the FOMC meeting minutes coming up. Yeah, they've got a meeting on 3rd through the 4th as well, which you can see here. And that's going to be an interesting release that should be out at about 7:30 a.m. Eastern Standard Time, about an hour before the market opens, but sometimes it is late. And same goes for the CPI. CPI data this month, according to the U.S. Bureau of Labor Statistics, is expected to be up. Well, it was up 1.2% in March, which is astronomical. Astronomical. The latest numbers for CPI were up 1.3% for most cities of all items. You know, that's quite, even more so on the West Coast. Look at this. This is not seasonally adjusted. So not seasonally adjusted, it was a 9.4% increase on the West Coast, 8.5% throughout the rest of the U.S. cities averages. And that's quite terrible for the vast majority of Americans, I've got to say. That's absolutely very sad. And you're seeing a lot of people right now talking about switching political parties. I don't really care less at this point. I think they're both evil, bunch of evil bastards. But there's nothing that I'm going to be able to do about that directly. So I'm going to continue on and try to warn everybody that we can about this fucking bullshit they're trying to shove down your throat.
Yeah, it's too late for that.
Exactly. That's not. We can't go back. Not even the Fed can catch up to this one. 10-year yield tops 3% for the first time since December 2008. I want to thank Jam Bams and T for your support and for sharing this information with us amongst other people. This is the first time since December 2018. And what happened on September 17th, 2019? The reverse repurchase program crashed, the cost to borrow flew to 11%, and the Federal Reserve had to step in and save the overnight RRP in order to bail out banks every single fucking day. With our tax dollars. Ain't it grand? Here's the 10-year yield going positive for the first time since March 2020. Look at the federal funds rate. Look at how low the federal funds rate now in accordance with the federal yield. It's at 0.50. Let me scoot this over. It's at 0.50. This is the upper bound. And what are they going to do? Is the government able to reduce our interest rates any further? Absolutely not, because you see the way hyperinflation is. So if they reduce interest rate, what's going to happen? The market's going to run hotter. People are going to continue to spend more money. The economy is going to, the GDP is going to continue to be artificially pumped, and inflation will run even hotter. So we cannot bring down the bond market by reducing rates. The government has overprinted way, way too much fucking money. This is Japan. They've been dumping bonds hand over foot. And what's the incentive for them to buy at these levels? Where's the incentive? Every time we see a huge rise in things like the Japanese yen, the Chinese yuan, and a decrease in the United States dollar, which we're currently still also seeing an increase in the DXY for the time being. But once we see a reversion to the yen and the yuan, amongst other asset classes, such as gold and precious metals and so on, we will see a further devaluation of the dollar and further hyperinflation for us. Can you guys believe that Ken Griffin had the balls to come out and say that the Fed should raise interest rates to 4%? Ken fucking Griffin. Robbie Calkins said Ken Griffin is so fucking corrupt and loves BBCS. I'm so glad I didn't read that before I said it out loud. Ken Griffin has entered the chat. Thanks, Reginald. Appreciate you, brother. Thank you, guys. You're too funny. Ken Griffin warned that we are in perhaps the highest uncertainty since the great financial crisis. He said, "We don't know if inflation expectations have become unanchored." And he said the West is facing existential problems. He also said that the Biden administration is deluging corporate America with regulation. Those are bold claims from a man who makes money by front-running trades and selling himself, or should I say his companies selling themselves shares of stock which they don't own. Now, those are some bold allegations, I know. However, they're not allegations, they're actual facts. Because Citadel has been fined for wash sales, hundreds of thousands, if not millions of times at this point. It's a fact. It's a slap on the wrist. And they continue to get away with it day in and day out because it's the cost of doing business for them. Where is this one at? Oh, look at that. Finra Citadel Securities report. There's a lot in here. Those are a lot of finds. Look at this. I'm scrolling through this extremely quickly. We are on page 86 already, page 102, page 125. There are 184 pages worth. Let's just stop randomly on one page. Citadel Securities failed to report to Finra and NASDAQ trade reporting facilities the correct symbol indicating the capacity of the contraparty transmitting orders to the firm for execution in reportable securities, and in 2 instances, the firm failed to report the correct symbol indicating the capacity in which it executed transactions. The firm transmitted reports to the Order Audit Trail System, OATS, which is now out, and CATS is now in, which is going to fuck them a little bit more, that contained inaccurate special handling codes, or in some instances, the reports contained inaccurate capacity codes. What was their fine for this? $15,000. Without admitting or denying the findings, the firm consented and paid their measly $15,000. How much money they made off this, one can only guess. But it's a recurring situation that you've got. And if you even want to search I just typed in the word wash. And the allegations are that for the sole purpose of settling the disciplinary proceeding, and without admitting or denying any allegations, the applicant stipulated that during the period of January 2010 through April 2013, Citadel violated New York Stock Exchange Rule 342 and the New York Stock Exchange Supplemental Liquidity Provider by failing to maintain supervisory procedures, including a system of follow-up and review that were reasonably designed to detect and prevent volatile wash trading activity. This is one of many. Here's another one. The firm submitted an offer here, an offer settlement on September 10th, 2015, which was accepted and received as relevant findings. The firm failed to establish and maintain reasonably designed risk management controls. And these were procedures to assure the appropriate surveillance personnel received immediate post-trade execution reports, specifically wash sales, as required by SEC regulations, in that the firm did not have a wash sale report covering the retail broker-dealer order flow handled by the firm's equity market making desk. What does this mean? This means they make a shitload of money by committing wash sales, and they get those orders through payment for order flow from companies like Robinhood and Webull. Plain and simple. This is why your purchases and sales, if you're buying on payment for order flow brokers, are not affecting the stock price, amongst other reasons. But the main reason.
You know, I do have to say, with the amount of fuck-ups that they do and still can get away with it, I mean, it's truly amazing. If any average person fucked up like that, we would be without a job. Like,
Pretty
this
much.
is fucking criminal beyond belief.
We'd be probably without a job and also in jail. We do not get the right to pay fines less than the crime committed every time a crime is committed. Or should I say a rule, a regulation? What's the difference? So as you can see from this, the implied overnight rate and number of hikes coming are currently pricing in about 75 to 100 basis points by June, which means 0.75% to 1.0% total by the end of June, in July and September are also pricing in their own individual 50 basis points on top of that, and 10 more on top at the year end. So that brings us to a total of around 2.5%, which is nowhere near high enough. Nowhere near high enough by the end of the year to curb inflation, and we're only at a 25 basis points increase, a quarter percentage point, and our stock market's already falling apart. Things are going fucking nuts. Absolutely batshit crazy. The plunge team is working all around the world to save bonds, to save stocks, to save equities, Forex, and everything in between, meanwhile suppressing certain equities that have been heavily shorted, like AMC and GameStop, and precious metals like silver and gold, amongst many other things. All the meme stocks, you name it. Which, I mean, I'm sure that does change also. But I think if you've seen them, you kind of have an idea. Look at the volatility index. The U.S. high yield collateralized debt securities in red, and the investment grade collateralized debt securities in blue, along with the volatility index. Look at what's happening to the credit. This credit is constantly fluctuating. These credit default swaps increasing proves that mortgage-backed securities are about to take a shit. Why? Because credit default swaps, these CDOs, these collateralized debt obligations, CDOs, are based as a hedge against mortgage-backed securities. So when commercial mortgage-backed securities and regular, household mortgage-backed securities start to lose value, whether it be in China or Russia, America, or everywhere in between, credit default swaps start to get purchased up by the millions. Huge amounts of transactions in these swaps to protect themselves against their bad bets in the real estate markets. This is the widest spread we've seen since the COVID crackdown. Plain and simple. Maybe I shouldn't even say those words on the channel anymore. It seems like every time I do, it's not seen as a good thing by the YouTube algorithm. I'll say that much. This was a slight rebound on the dollar right here. Also, it hiccuped right along with everything else in the equities markets, and Bitcoin kind of did the same thing. Take a look at Bitcoin. Meanwhile, you've got commodities like natural gas just fucking rallying. 5% increase on the day. That's a really bullish movement for this commodity, and not so much for the people that are going to need to buy these commodities. Natural gas. We all need natural gas for the most part to heat our homes, to heat our stoves, and for many other commercial purposes. Grandpa Barney, thanks so much for your support, brother. I want my fucking money, Ken Griffin. I want my fucking money. Take a look at this. Gold. Gold is well below where it was when Vladimir Putin invaded Ukraine. But it's still trading at 1860. At the current time and moment, Putin is working on getting the gold linked to the ruble. More so than just the current temporary peg that's going on. What happened with oil? Diesel is at very high levels, $6 a gallon in many places right now. And it's gone up over $1 a gallon just over the weekend for many people. Oil prices, just the futures, as you can see, first thing in the morning, just shot up as soon as the market opened at 8 a.m. from about 101 up to 105. It's probably going to be a recurring pattern. Of course, we all know oil is very volatile, so be prepared for anything, because the unexpected keeps happening, because liquidity continues to be drained from all sorts of different facilities, whether it be equities, bonds, lines of credit, lending facilities, swaps, ISDA contracts. or emerging markets. There's a lot of places. Look at crypto. Look at the NASDAQ and how closely the NASDAQ in blue follows rate hikes. Do you notice when I say it's not priced in that something has changed? I hate the saying it's priced in. I fucking despise it. Because it's not always priced in. It was. But look what happened here on the NASDAQ. Right here in the beginning of March 2022.
Yes, transitory too.
I suppose. But the last time we had even a much smaller deviation, we saw a very large correction in the NASDAQ that continued onwards. This arc nonsense here of NASDAQ overvaluations will catch up to the rate hike expectations. It will. It's only a matter of time. I guess the fact remains, how much farther can this shit get kicked? How much farther can this game be played by the Federal Reserve before they fold? That I can't say for sure. I don't think anybody can say for sure. But it's a long time overdue. There's nothing left with which to save these fucking markets. Nothing fucking left here. Now, they've got liquidity, and the more people that are still using ISDA banks, as my man AMC Bigums likes to say, make sure you check him out on YouTube, the more people that continue to put their money in ISDA banks, the worse it is for everybody who's invested in the stock market. Why? Most likely because these ISDA banks use your money the moment you deposit it to trade, oftentimes against you, directly against you and other retail investors. Should I say indirectly? Indirectly would be a better term because it's not directly against you. Your bank doesn't have anything, they don't have anything against you necessarily. They just don't give a shit about us. They want us for money, and that's it. To use us for an opportunity to stash some cash.
We're just trade collateral for them.
We're wage slaves. We're wage slaves to make deposits and withdrawals and give them vast amounts of our money to use against us on the stock market. If you've been following this channel, you're probably aware of American sanctions against China. President Biden and Janet Yellen have been speaking fiercely against sanctioning China. This was an article from the Financial Times. It says that China meets banks to discuss protecting assets from U.S. sanctions. Officials are concerned that measures taken against Moscow could be applied to Beijing. And again, if you've seen this channel before, you would know that the sanctions against China were so severe on January 28th of 2021 that they caused a massive short squeeze in American markets, in my opinion. As you can see here, and it is alleged that the White House called Virtue Financial, the market maker, and told them and colluded with them to stop trading, to go position close only on AMC and GameStop. That is an allegation that came out on January 28th, 2021. I find that hard to believe is an allegation. It is hard to find, but I will find it for the next stream. Also, the same collateral was taken away from hedge funds and market makers and banks and prime brokers on May 27th, 2021. the same date that AMC and GameStop started running again. And just a few days later, on June 2nd, AMC ran to its all-time high of around $79. The day after that, June 3rd, 2021, Biden passed another executive order, 14032, on June 3rd, 2021. This gave back the collateral to these hedge funds and market makers for a period of 365 days. Therefore, on June 3rd, 2022, at 12:01 a.m. Eastern Daylight Time, all of this Chinese collateral will be completely worthless once again. Not only is it the original 30-plus military companies that were on there, but an additional 30 more that were added on in February of 2022 by the United States Treasury via this regulation amendment on a June 3rd executive order that was added on the Federal Register Wednesday, February 16th, 2022. Well, these are these assets that they're trying to protect. There are Chinese banks are trying to protect these assets. There's not much that they can fucking do about it, and they know it. Chinese regulators held an emergency meeting with domestic and foreign banks to discuss how they could protect the country's overseas assets from U.S.-led sanctions similar to those imposed on Russia for its invasion of Ukraine. Officials are worried the same measures could be taken against Beijing in the event of a regional military conflict or any other crisis. There was an internal conference.
Like Taiwan.
Like Taiwan, or avoiding the SWIFT system with Russia, supply chain blockades, a lot of things it could be. The officials and attendees did not mention specific scenarios, but one possible trigger for such sanctions is thought to be a Chinese invasion of Taiwan. This is directly from the Financial Times, and if China attacks Taiwan, said one of the people briefed on the meeting, quote, decoupling of the Chinese and Western economies will be far more severe than decoupling with Russia because China's economic footprint touches every part of the world, said one of the people that was briefed on the meeting. Some bankers present, however, doubted whether Washington could ever afford to cut economic ties with China, given its status as the world's second largest economy, huge holdings of dollar assets, and close trade relationships with the U.S. Collier, a Chinese banker, said that it is difficult for the U.S. to impose massive sanctions against China. He agreed, it is likely mutually assured destruction in a nuclear war. He's not talking about a literal nuclear war. He's talking about the mutually assured destruction akin to a theoretical financial nuclear bomb going off. And we've seen that just two companies alone, BlackRock and Vanguard, have trillions of dollars worth of this emerging market Chinese bullshit. BlackRock and Vanguard, on the Financial Times in a previous article, faced having to offload billions of dollars worth of investments in order to comply with the U.S. government's decision to blacklist Chinese companies. Which decision was that? This one, right here, January 28th, 2021. This one, here, May 27th, 2021. Which one's coming next? This one, here, June 3rd, 2022. Executive Order 14032 by President fucking Biden. Cash, what do we like to say about him?
We're gonna be rich by executive order.
Fucking Vanguard Emerging Market ETF Index Fund has almost $72 billion in assets as of January 6th, with a 43% exposure to the Chinese market at the time. They said that since the executive order was first announced, they've been keeping everyone prepared with responses for inquiries, and Vanguard will fully comply with the executive order and continue to monitor the situation to ensure ongoing compliance. BlackRock also had iShares Core MSCI Emerging Markets ETF, $70 billion in assets, and a 36% exposure to that same Chinese market. That being said, China knows that this is bad news for them. America knows that this is bad news for them. But Xi Jinping continues to push the notion that Taiwan is land of China. Taiwan belongs to China. It is part of China. It's not something that they're going to just cease to believe and pretend is not what they truly believe. Look at what happened with Vladimir Putin and Zelensky, and how many people did not believe that Ukraine would be invaded by Russia. But right here on this channel, since December of last year, the think tank has been telling you that it's coming. Again, none of us can see the future, but we can read the writing on the walls, and I can feel which way the wind blows. I think it should be clear right now that these Chinese banks and these American and worldwide prime brokers and hedge funds like Vanguard, BlackRock, Citadel, the market maker, and the hedge fund, as well as the broker dealers, are freaking out. They're freaking out, and pretty soon we're going to see another massive explosion of stocks and an implosion of FANGMAT, NASDAQ, blue chip bullshit. It's probably going to tank. Because when you own this much blue chip shit, you have to have something with which to hedge against it. You have to. And what would that be? I would say it's probably stocks like AMC and GameStop, and silver and gold, and many other things akin to that. BlackRock has 40 million shares of AMC theaters. 40 million shares that are loaned out to assholes like this, like that. When they get margin called by the DTC because they've got too much emerging markets ETF bullshit, we've already been told clearly by Vanguard that they will comply. They will fully comply with any government orders and executive orders. Unfortunately, this leads us to another thing. This leads us to the fact that at the same time, right around this June 3rd date, we've got another issue, and that's that military TSP accounts will be locked. From May 26th through the first week of June, account access will be unavailable. But accounts will still continue to reflect changes in the market. If you're a member of the military or a federal employee like the United States Post Office, I would highly recommend that you do something about your investment, whatever is best for you. I'm not a financial advisor. Whatever's best for you, because it will be unavailable for about a week or two. And with the way the current market is taking an absolute fucking aneurysm dump all over the place, I would be very concerned as to if my money is going to sit, where my money is going to sit for a period of 2 weeks. The only reason that it makes sense that this line up, because it would prevent all of these people from withdrawing their money from their accounts. If their TSP, their thrift savings plan, shoots through the roof and makes them a shitload of money in the spur of the moment because they're invested in asset classes and certain index funds that hold AMC and GameStop and other meme stocks. In addition, if the stock market collapses and a shitload of blue chips just also collapse, those same thrift savings plan members that are locked up will be unable to sell to stop their losses. That's why it's important. Some people say that there's a G rated or a level G bond related return, that it is supposedly guaranteed based on bonds, but I don't know if that's true or not. If it's based off the price of bonds and the bond market is all over the fucking board, where are we at here with the bonds? I know I've got it up here somewhere. Guaranteed, and it's just a figurative a figure of speech, then it's not such a sure investment, is it? So I just want people to do their own due diligence, to really look into it, and do what they have to do to hedge themselves properly. Because a collapse is probably in the works. And at the same time, many, many stocks, just like they did after AMC and GameStop went position close only in January and early February, other stocks also ran heavily. Look at Naked Brand, it's up 1,800%. Sundial was up 1,600. Zyomedica, 3,000%. Fuel Cell, 1,200%. Ideanomics, 500%. And so on. Some of them a little less. Castor Maritime, 1,341% on February 11th. Another small run, 10%. Here's another 151% run on the 9th. 674% run on February 10th. Another 88% on February 9th. February 19th, 528% on Oncova Therapeutics. And a lot of these stocks ran thousands of percent. Foresight Autonomous, February 10th, 1,080% almost. Senseonics on February 16th, 1,310%. BioLays, 400% on February 9th. Canopy Growth, 187% on February 10th. Kronos Group, 188% on February 10th. Aurora Cannabis, 385% on February 10th. And the list is huge. CPS Technologies, 1,400% on February 16th. Gevo, 1,388% on February 10th. Orbital, 1,250. Ocean Power Technologies, 214. And so on. Organigram, 400%. Blink, 678%. Hexo, 264%. Bionanogenomics, 2,894%. Ocugen Inc., 5,259%. And most recently, a lot of people have taken a liking to stocks like Mullen, BBIG, BBY. They also ran in February, and they moved up crazy amounts percentage-wise. The God Pill, thank you for your support. Appreciate you. I'm not sure if I should really read that out loud because I don't know if it's the truth or not. However, I don't know about Mullen. However, I do know that AMC is owned over 90% by retail. We own the float. 4 million retail investors in AMC own over 516 million shares. That has been verified by AMC. That means that all of the institutional shares and all of the shorts reported and not reported, that means all of those that are not reported and all those shorts marked as long, are all synthetics. So if the same is for Mullen, that's great because I own some Mullen calls, as do a lot of people. I own several call options on Mullen, and I'm feeling pretty good about Mullen as well. You know, I own calls on a lot of things, and a lot of these other stocks. Look at Tilray, 1,083% on February 10th. Not bad. Not bad. So please do your own due diligence, everybody. I would like to thank you all for your support. If you found some value in this stream, please consider sharing, liking, and subscribing, as it does help the algorithm and it shares it with other like-minded people that need to learn about this sort of information. There's a lot more with which we could go over. Ferrari Boy asked, can you explain why it's unlikely Biden will extend the executive order over and over? Well, Ferrari Boy, it's definitely possible. Of course, anything is possible. But look at the situation going on with Russia and Ukraine and the assistance that China is providing them. Look at the situation going on with China and Taiwan. And the fact that America is sailing warships through the Taiwan Strait and the Chinese Strait. These acts of aggression are not going to get Xi Jinping or Biden to back off of each other. They're a bunch of rabid dogs. They don't care the way that inflation kills our pockets. They don't care that it hurts us because it's better for the government that inflation does keep the people down, keeps us as wage slaves. The unfortunate thing is that this time, the Fed is way too far behind the curve, and a recession and a depression, in my opinion, and in many experts' opinion, are at this point, unfortunately, imminent. And at the same time, the mutually assured nuclear destruction that was discussed by those Chinese bankers that are oh so worried about what effects that's going to have. And you bet your ass that Vanguard and BlackRock, as well as all the other market makers, banks, hedge funds, family offices, prime brokers, they're all going apeshit. Even the shadow holding companies Because as we know from the newest DTC regulations, that they're no longer able to use their parents' assets as rehypothecated bullshit collateral. The DTC collateral haircut started Monday, May 2nd, 2022.
I think meltdown imminent.
Whether Biden extends it or not, the stock market is still gonna fucking crash. It's not a matter of if, but when. And it's, in my opinion, probably coming a lot sooner than most people can imagine. Because I still got my eyes on June the 3rd. That's not saying that everything's gonna happen by that specific date. It's just a date that people need to keep their eye on. So with that being said, I wish you all peace and wealth, because we're gonna be so goddamn fucking rich.
So goddamn rich.
Get the goddamn money printer out, Jerome Powell, because you're gonna fucking need it, man. You got way too much money to print for these apes.
Brr, brr, brr.
Come on, man. Come on, man.
Hey, just one other thing to add on.
Gonna be so goddamn rich.
Extended executive order.
I think it's time to blow this thing. Get everything this stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker. Holy shit, we're gonna be so fucking rich. Damn it, we're gonna be so fucking rich. Griffin, I want my fucking money.
You're an original,
Hey,
aren't you?
yelling, give me the fucking money.